let's get some perspective then with our market master. Krishna Sanghavi, Chief Investment Officer Equities at Mahindra Manulife Investment Management, is with us in the studios now. Krishna, great to have you right here with us. The market's not used to pauses, right? This market runs on steroids. It's almost making all-time highs on a daily basis. But pauses can be healthy. They can be very good. What do you make of things right now? I mean, is it tough to find stocks at your buy price? Or do you think this is a multi-year bull run? So why worry?
Yeah, it's a combination. Clearly, it's tough to buy a stock where you're comfortable at that point of entry valuations. At the same time, if you really decide to have a longer time frame, then something life becomes easier. Unfortunately, you don't know how much, in a way, from a time-wise, you're overpaying today. Because very fact you're willing to buy in 3 and 5 year down the line earnings means it's really overpriced for the time being. And so all you need is maybe incremental, dose of order book, incremental dose of, positive announcements which possibly can help. But yeah, clearly many of these companies right now are in a situation where at least FY26 is nicely discounted and one has to stretch in terms of looking beyond.
Okay. Krishna, hi, good morning. And, thank you for being here with us in the studio. Appreciate it. How are you reading into this move in banks? Because suddenly, it's become everyone's favorite. Private sector banks have underperformed for 12 to 18 months.
Yes.
But do you think that's the only reason, underperformance, or is there some fundamental trigger for this move in banks?
Yes, so I think markets are always going to be a combination of both, some fundamental as well as this. So I think if you look from a relative earning perspective, maybe banks still offer a nice spot where if you go back 6 months back, maybe there was expectation of a rate cut. And as we know, when the asset price starts repriced downward much faster, banks could have some impact. Now where we are today, maybe that rate cuts looks reasonably difficult, or the intensity can be far lower. That is one part, which is the earning side. I think if you look from a market ownership perspective, clearly that's the other angle, which says that they have underperformed beyond a point. They're all good franchises, best of situations on margin front, on credit cost front. So that's the other angle, which says companies are good. Maybe they've not moved much in last, 6-12 months. They were definitely added income. They've added profits. The book values have grown. It's just that, from a relative perspective, maybe the over ownership somewhere has hurt, because when some other segment of market started doing well in terms of economy, not necessarily only equity markets. So people, would have shielded some portion of money, and, in a way, financials would have been a natural port of call considering the ownership, pattern. So that's where some money gets taken out to invest somewhere else.
All right. Hi, Krishna. Good to see you in the studio. Give us a couple of, numbers and your analysis of the same. Prior to this election outcome, everyone was going gung-ho on the Capex themes.
Yes.
Now, suddenly, post the outcome, people are talking more about consumption themes. But that lasted for all of 3 days. When you saw the FMCG names do very, very well. And the street said maybe you have to rejig yourself from Capex to consumption. Would you look at buying some of these consumption stocks, or do you think that the Capex has a far longer runway, so you rather stick to those themes itself?
No, sure. I think, let's look at macro picture of economy. I think all sectors are interlinked. We have, this concept of profitable participation, where some sectors lead the earning growth, some sectors, lag it, but net, economy keeps on growing. If you look at last 10, 15, 20 year cycle, you will always find those spots where, where a particular sector looks really good. Unfortunately, somewhere, the valuation call starts coming into place saying it's good, but at what price and what's the incremental, return expectations. I think if you link to election, primarily, I think, let's face it, we actually in the same continuation phase. So nothing incrementally, is different. A lot of Capex announcement which would have happened earlier are possibly likely to continue. So it's going to be more of a valuation call, and that's where, the thought process comes in, is that as and when some of those Capex cycles which was initiated sometime back starts getting played out. See, what's the end game of Capex cycle, right? End game of Capex cycle is higher manufacturing, which creates, income for people who are employed. So it's, job creation, it's some Indian factors of production being paid out, as a part of this cycle. So to that extent, consumption is a natural beneficiary, as people learn, let's not forget, my expense is somebody's income, and that, when the other person starts spending, the third person starts earning. So I think that's how this cycle of Capex consumption gets played out, over time.
So let's talk about the portfolio construct. In general, given that this is a market, like you said, where valuations are pretty hot in most pockets, which are incrementally, what are your current overweights? And incrementally, when you have to put fresh money to work, which are the areas where you still have some valuation comfort?
Yeah. Sure. So I think traditionally, for last 12, 18 months, Capex cycle was clearly an area of, overweight and that's possibly helped, our portfolios as well. So that's been one part. At the same time, as I mentioned, valuation is something which is reasonably attractive or, cheap 1.5 year back. It's no more the case. So to an extent, valuation-based adjustments to portfolios and maybe private banks, maybe, consumption. And within consumption, honestly, it's a nice basket, right? You got FMCG on one side, you got consumer durables, you got within that lower price point, products versus a higher price point. So I think that range is there. So little bit consumption tilt on an incremental basis clearly helps, yeah.
But, let me ask you a follow-up on that. The reason why the market was not buying FMCG, of course, it was always under-owned and the valuations were always good.
Yeah.
Well, because do you want to buy something that's going to give you 4-5% growth, right? Whereas something like an ABB or a Siemens or a HAL, though trading at 50 times to 100 times, was still, giving you the prospects of more growth going ahead.
Agreed. So that's a tough call. That's where everyone gets into valuation and our own understanding of how long this cycle is going to last.
So what do you think there's going to be a change? Do you expect higher growth? I mean, the under-ownership argument is well taken on FMCG, but will growth come back?
So that's a growth argument which says that if those capexes which were created or planned some time back are going to be operational in next 12 months, so the job creation starts, right? Because what does consumption need? Income growth for people. Now, people at relatively higher end of income possibly are not going to be impacted by incremental income generation. But at the same time, people in the mass segment, average income can shoot up because of economic activity picking up. That's the end game, right? It's a cycle. Companies produce things and create jobs for people. So that's
So just to complete the loop on this, have you started booking profits on the Capex side of your portfolio?
Yeah, I guess valuation led, some reduction. That's where, as a portfolio is constant, right? Finally, it's 100%. So if you want to buy something else, you need to review something else also.
Okay. Well, just a last question from my end. We have the big budget coming up and, this is going to be a different one because this is after the third time that the government is getting re-elected, right? So I'm sure they have some aces up their sleeve. Yeah. What do you think the government will announce which could perhaps improve the mood of the market? I mean, from a market perspective, what are you looking at?
Yeah, honestly, market mood is good, right? so as she was mentioning steroids, so, I don't think, market mood needs something booster. I think bigger part is perhaps, nice roadmap of next 5-year thought process. Because it's a first budget in a way, though it's a continuation of the government on every front, including the ministry. But yeah, to that extent, what is a new agenda for next 5 years possibly can be one. Otherwise, broadly, it's continuity. I think the fiscal consolidation, which we've been going through, is reasonably good. Luckily, tax collections are nicely supporting. So I think those macro factors will not be really something different on even from a budget perspective, apart from saying that some 5-year plan, which is...
But do you think the focus area will continue to be from a market and a budget standpoint, things like manufacturing, perhaps defense, affordable housing? These are spaces that the government has been big on lately.
Yes. So I think that remains. I don't think that incrementally changes because that's what, maybe the roadmap for next, 5-7 years of this decade are all about.
Okay, all right, Krishna. Thanks a lot for stopping by and giving us your view on markets in various sectors as well that we discussed. Wishing you a good day ahead.
Thank you.
Thank you.